Hello, everyone. For those of you here, we're going to start in maybe 30 seconds. Just a housekeeping item for Q&A. Feel free to put your questions in the chat. We might go through a couple live per slide, but generally going to hold off till the end to address all of them. And thank you for joining. We'll be kicking off shortly. All right, we got a lot of slides, so I'm going to get started. Thank you all for joining. My name is Devin Medrick. I'm a tax manager here at Leyton on the innovation team. So we handle research and development credits, orphan drug, grant funding incentives. Specifically, I've been focused on 174 compliance, the capitalization compliance that we'll be recapping today. I came from PwC before that, and I'm excited to chat with you all today. Ben?
Perfect. Thanks, Devin. Hi, everyone. My name is Ben Brissett. I've been with Leyton coming up on 5 years now, working primarily on an innovation funding team. My background is in accounting. I've had my undergraduate in accounting, my MBA, and I'm currently studying for the CPA exam. So happy to be here, happy to chat through some of the changes with the One Big Beautiful Bill, as well as just an overview of the R&D tax credit as a whole. And, let us know if you have any questions. I'm looking forward to chat.
Okay, so the agenda today, the main bread and butter, we're going to talk about the new bill that everyone's probably heard of, the OBBB, specifically around research and development. We had a webinar last week that covers all of our products. We'll touch at those towards the end, but mainly this is going to be R&D focused, treatment of costs being affected by this bill compared to the last few years of treatment mandates. We're going to do a little recap on the research and development credit itself, what kind of costs qualify, what activities qualify, what's the IRS's criteria. For those of you who haven't claimed or have clients who haven't claimed for a couple of years, hopefully that's a useful refresher. We'll do a little bit of kind of admin housekeeping for tax year 25, updates to the new form, tax deadlines, etc. And we'll kind of recap other services, etc., and do Q&A for hopefully 10 to 15 minutes towards the end. So starting with the bill, this was passed on July 4th of this year. And even that, starting a little backwards, actually. What kind of the bad part of research and development treatment has been over these past few tax years. This started per the Tax Cuts and Jobs Act, or the TCJA. It was passed in 2017, but this stipulation on research and development costs treatment enacted for tax year 22 through 24. So it basically said, as most of you probably know, that research and development costs need to be capitalized and amortized. There's no immediate deduction allowed for those costs. That's regardless of whether a company is claiming the credit. Technically, it didn't affect the credit. The credit was still calculated and utilized in the same way. But the costs that quantify or comprise the credit need to be capitalized. Couple reminders or refreshers. US-based costs, which is 100% of most US companies' research and development costs, need to be amortized over 5 years versus immediately deducted. And then foreign-based research costs incurred by a US company need to be amortized over 15 years. We'll have a couple of reminders on this, but that is still in effect even with this new bill. The new bill affects domestic-based costs. And one more reminder on what the situation has been for the past few tax years. This was a mandate for both direct, quote unquote, and indirect research costs. So not only direct being wages, supplies, contractor costs, computer leasing costs in association with R&D, but also utilities, rent, depreciation on a building or equipment used in R&D, patent costs and associated legal fees, all sorts of indirect overhead sort of costs that also needed to be capitalized in portion per the TCJA. So what the bill does now for tax year 2025, it basically says that's not a rule anymore for domestic costs. No need to capitalize them. They're back to being able to be deducted in full on a return, whether timely or amended. So they created this new section that, again, 174A allows for immediate deduction of domestic research costs. So if you have claimed historically, whether it be a CPA or you, the company, this would be back to 2021 and prior treatment, where you can just take your deductions and claim the credit. A couple other key things, and we'll get more into detail on these in the next slide. But there is some relief available for tax year 22 through 24 in relation to this bill. So eligible small companies can amend their returns, particularly if they initially capitalized on their timely filed returns. They can definitely amend to essentially uncapitalize those costs and take deductions in full and the research credit on those amended returns. And there's a 1-year deadline to do that, and you can see the eligible small business criteria there. So if you did capitalize correctly, you can go ahead and amend to correct that and undo it, and you would be due a refund. Like I said, more detail on the next slide. But the other thing available for all taxpayers is that you can accelerate any remaining capitalized research cost amounts, either on 25's return or on both 25 and 26's return.
So going into a little bit more deeply, as Devin mentioned, there's a couple different options that you're able to do if you had claimed the R&D tax credit and capitalized these expenses over the past couple of years. One of them, or I should say two of them, the accelerated deduction and accelerated amortization, is available to all companies. The going back and amending returns to retroactively claim is only available to small businesses, and the IRS defines small business in this sense as having less than $31 million in gross receipts over the past 3 years. So you would look at 2022 to 2024, and if you had less than an average of 31 million gross receipts over those time period, you're able to do any of these three options here, whichever you deem to be the most appropriate. Going into these options, as Devin kind of mentioned, is number one is just amending your returns. You can go back and retroactively deduct all the expenses that you previously capitalized and have been amortizing. This allows you to go back, get that full year deduction in that original return, and allows you to get a cash refund in hand. Now, with that cash refund, there will also be some added interest that the IRS pays out as well. So you have a little bit more of a benefit on top of that. But on the downside, you do have to go through the filing process. You have to go through the additional expenses of, connecting with tax professionals to get that filing done, as well as waiting for the IRS to ultimately process it and refund that, refund your credit or the deductions in that sense. So it is a good option, especially if you had high tax bills in prior years, and you might not in the upcoming couple of years. But it also is a little bit of a downside because of the waiting period to ultimately receive that benefit. The other two options, which are very similar in nature, it's spread out over 1 year or 2 years. It's a little bit simpler to do, is just accelerating your amortization and taking the full deduction in 1 year or 2 years. So essentially they allow you to take either all capitalized expenses and accelerate that in 2025, or split that up between 2025 and 2026. As I said, it's a little bit simpler because you don't have to go back. You don't have to amend anything. You can just put it on your next tax filings and take advantage of that, on that filing and be able to deduct against any income that you have in those current years. On the downside, it doesn't have that cash in hand refund, but again, it might be a little bit quicker and certainly is simpler to do it this way. So you can weigh the pros and cons of both options here to see which is better for you. The other thing to keep in note is because of this high deduction that you would get in 2025 or split up between the 2 years, is you might be in a net operating loss situation and have that carry forward, or potentially also be carrying forward your R&D tax credit. Now, we'll get into this a little bit later, but that R&D tax credit doesn't have to be used all in 1 year. You can carry it forward, so no worries if you are in this position. It's just something that you can bank for future use. But it is worth noting that if you're taking a large deduction in 1 year, abnormally large compared to what you normally you have been doing in the past couple of years, you might be in a position where you have those NOLs and it's going to be carried forward for a couple additional years. Moving forward, what this means, tax year 2025 and onward, just full expensive of all R&D costs. No more amortization, no more capitalization of these expenses. Specifically to domestic expenses, as Devin mentioned, we still do have to capitalize and amortize any foreign-based R&D expenses, but anything that is eligible for the R&D tax credit, they have to be domestic. They have to be domestic expenditures in nature to begin with. So all these R&D costs can be fully deducted in the year in which they were incurred. This in turn increases the Section 41 credit, because not only do you get that full year deduction, which you were able to do in the past, but you're also able to get that dollar for dollar offset on your tax liability. And as I kind of mentioned on the last slide, it just simplifies things again. You don't have to weigh the pros and cons of putting money towards innovation versus saving tax dollars because of those amortized expenses. It just supports cash flow, incentivizes innovation, domestically, and honestly just simplifies everything moving forward. So all good news on a forward-going basis. Still a little bit of uncertainties on the prior years as far as the true utilization of it. But that's something that Devin will go a little bit further in here as well.
Yeah, we had a good question. Just to recap, for option 3, the 2025/26 option to accelerate amortized costs, does that need to be even split, or can you choose whatever? It doesn't need to be 50-50. So 50% remaining capitalized amounts on 25, remainder 50% on 26. Ben, you'll see that other question. Up to you whether you want to address that at any point.
It does not.
It doesn't. Okay. So a recap on the bill. Just there's one main uncertainty, and we would definitely recommend that all companies confer with their CPAs on this sort of stuff, and we will be waiting for more guidance on it. That's kind of our stance. But the uncertainty is, if you as a company haven't capitalized or claimed R&D over the past few years, does this bill allow you to amend and just take full deductions in the credit? The bill doesn't specify that it doesn't. It just very specifically says this needs to be on an amended return if you want to fully deduct and claim the credit on 22 through 24. So our expectation, I think loosely, would be that, yeah, even if you quote unquote didn't do it right the first time, didn't capitalize anything, this bill allows you to amend to take full deductions. But that, we want to make it clear, that is the uncertainty that we're hoping for more guidance on. The very clear things, if you did capitalize initially, you can amend as long as you meet that small business criteria. And there is that 1-year deadline to do so. So by 7/4/26, you need to amend to take those full deductions and the credit for 22 through 24. The other crystal clear thing is that regardless of company size, etc., going forward, you can take your deductions and take the credit as the program was intended. The last thing I think is useful to note, for whatever reason, if you do want to continue to capitalize and amortize costs for 25 and onward, there is the option to do that. It would remain as a 5-year amortization period. And if any company just doesn't want to fully deduct, that is still an option under 174 versus 174A.
Next, I'll just dive into a little bit of the R&D tax credit, give an overview of it as a whole. I know many people on this call probably have worked with it in the past, but might have been a couple of years since you have. And there have been some changes to the tax reporting and filing standpoint. So we'll just go do a little bit of an overview of that. First and foremost, a little bit of history of the R&D tax credit. It was first established back in 1981 during the Economic Recovery Tax Act, and then was later made permanent in 2015 by the PATH Act. PATH Act also introduced a payroll option. So in addition to the income tax credit, there's also a payroll tax credit. And then it was later increased, I believe it was in 2022, to increase your payroll tax ability from $250,000 up to $500,000 per year. Now, the payroll tax credit is only available to companies within the first 5 years of generating gross receipts. So it is a max of $2.5 million in payroll tax credit. But it is an additional option for companies that are at the start of their business, might not be in a tax paying position, but can still offset some of their payroll tax liabilities and continue carrying forward that as well. The standard credit that most people think about is the income tax credit. This is that dollar for dollar offset against any income taxes owed. It does allow for a 20-year carry forward as well as a 1-year carry back. So if you can't utilize the full credit in 1 year, no harm in that. You just are able to bank it, carry it forward, and then use it to offset taxes in future years. Along with the federal R&D tax credit, many states have their own version as well. They don't typically have a payroll tax version of this, but they do have an income tax credit. Many of them are just as, if not a little bit more beneficial than the federal version. So, on a case-by-case situation, depending on which states you guys are filing your tax or your state tax returns are, we typically are able to look into those and almost double the benefit from the federal side as well. As far as what R&D is, the IRS sets forth a 4-part test to determine and essentially substantiate the work that's being done. It's not your standard working in a lab, petri dishes, and test tubes, so to speak. It can just be any company doing something that is new or improved to their own business. So number 1 is just a business component test. It's saying that there's something that is new or improved. It's a product, a process, a technique, a formula, but something that's new or improved to your own business that you're working towards for some type of end goal. To note, it doesn't have to be new or improved to an industry as a whole. It is just new or improved to your business. Number 2 is just making sure it's technological in nature. So for this, we just have to think about being rooted in the hard sciences. So biology, any type of chemistry, manufacturing engineering, computer engineering, things like that. We can't look at items like marketing or based off of feeling, so to speak, but something that is just rooted in the hard sciences. It would substantiate this test. And then tests 3 and 4 typically go hand in hand. Essentially, all these are saying is you're creating this product and you're not sure what that end goal is going to be or ultimately how to get there. And so you go through some type of process of experimentation. So you're going through these experiments to uncover some different alternatives or uncover the most optimal strategy to improve this process, for instance. And through this, you're eliminating some of your uncertainties and coming to that best solution in the end. Now, it's worth noting it doesn't have to be a success. It can be all failures, or you don't ever need to have failures. It can be an immediate success. Essentially, you're just saying is when you set off at the beginning, you're not sure if this is going to work. And so you're going through a process to determine if it does. And if it doesn't, what are your next steps to improve that moving forward? Because the IRS likes keeping things consistent in this sense, they also set 4 different cost categories that can be included once we're able to substantiate the work that's being done. Number 1 and number 2 are pretty similar. It's just employees or contractors' time spent. For this, you're allowed 3 levels of involvement. So not only somebody who's directly involved or the direct performer of the R&D, but anybody who's 1 level above or 1 level below, so supporting or supervising the work that's ongoing. We can take a percentage of their time, if not all of their time and salary, use it towards the R&D tax credit. On top of any employee's time spent or contractor's time spent, we can look at any materials. These are supplies and materials that are used and consumed to conduct the research. So not larger ticket items like equipment or depreciable assets, but items that are actually used and consumed during the R&D. So it's going to be, typically it's raw materials and smaller ticket items rather than any of the equipment that you guys are using. And lastly, we can include what's called computers externally leased for conducting research. Again, this was created back in the 1980s when people would go out and lease computers. Now we think of it more as web hosting, Microsoft Azure, Amazon Web Services, expenses like that, most commonly found in software development projects. But if you are doing any type of software development, anything with web hosting, we can often include a portion of those expenses related to the R&D as well. So as a quick case study here, these are just some qualifying activities from some manufacturing companies that we've worked with in the past, and some common standards across industry. If any of these type of activities are being conducted by either yourself or one of your clients, most likely they're doing some type of R&D. So if that's process automations, development of KPIs, product value validations, improving your process efficiencies, or improving your product quality, all these type of items are just again, qualified activities because you have some uncertainties, you're working toward an end goal, and you're trying to uncover something that you previously didn't know at first. So if any of these sound familiar, of course, this is more specific to manufacturing, but if any of these sound familiar or sounds like something you guys might be doing, it's definitely worth having a call and seeing if it's something that we can qualify, because most times the answer to that would be yes. And just to put some numbers on it, because I know we all like seeing some numbers. Here's a sample company. They had about 34 W-2 employees, about $200,000 in contractor or outside services expenses, and $1 million in consumable supplies. Through our study, through our process, we were able to figure out that about 42% of the employees' time was deemed to be qualified. About 10% of those outside services was qualified, and then 28% of the consumable supplies or raw materials were able to be qualified as well. So what we do is we take those totals, we multiply it by these percentages, and we get these total QREs, the total qualified research expenses, and that came out just over $1.5 million. The R&D credit on top of that is about a 10% of those expenses. In this case, it came out to exactly 10%, so a little bit over $150,000. But it's worth noting that it isn't just a straight percentage of qualified expenses. The R&D credit is what's called an incremental increase credit, which essentially rewards increased expenses over prior years. So we have to establish a base year to compare the current year expenses to. If you increase significantly, you might be more around a 12 or 13% of your QREs to credit ratio. Whereas if you had decreases of year-over-year expenses on the R&D side, maybe it's around 5-6% of total qualified expenses to the credit amount. So it definitely can fluctuate, but 10% is pretty standard, good estimate, and what we see most often.
Couple points I just want to make. I think we're going to stay on. We have 8 minutes left where the recording is going to be on, but we'll stay on for Q&A after that for the ones we don't address. But just one thing on the costs, especially, I just want to emphasize the foreign-based component, especially for software companies. Yes, you can, going forward, claim the credit, take your deductions, etc. for US-based, but a lot of software companies have foreign-based research and development departments and whatnot. So if you are claiming a refundable credit or one that offsets tax, definitely best to do it right and continue to capitalize those foreign-based costs. So we've been doing that sort of tandem analysis for the past few years, and certainly can and will continue to do so. But that's one thing to note. You still do need to worry about those foreign-based research costs. So just we'll whip through these filing requirements and whatnot. I think this first slide is timelines. So it's the typical deadlines. March 16th, actually, because it falls on a Monday, I believe. 15th is on a Sunday, so on and so forth. This next slide kind of alludes to why it's important, as most people know, to take advantage of these sort of credit programs on timely filed returns. We alluded to if you're going to restate 22 through 24, the waiting for refund process is probably going to be quite long. I think we've seen up to a year and a half, maybe more, for refunds to be administered. So going forward, at least for 25 and onward, make sure you include these credits on the timely filed return. We were talking about the payroll benefit earlier. That's only eligible on a timely filed return. But claiming the income tax credit will just offset your tax upon filing. You can avoid the whole riffraff of waiting for refunds upon an amendment. So that's one thing. There is extra reporting criteria with the attached statement that you need to detail all business components and kind of elaborate upon what the process of experimentation was and whatnot on amended returns for refund claims. So the point here is, work with us before timely filed. We typically start working with clients this fall, and then we gather cost info in January, February. That allows you to, file with our credit study on the timely filed, avoid amending. That's kind of the main point on this one. And just real quick, the 6765, which is where you claim the credit, continues to kind of expand upon its necessities for taxpayers. I think the IRS is just as much as possible trying to flush out fraudulent claims or ones where proper analysis just wasn't even close to being done. So there was a change for 24, which basically said you need to report the number of projects, the officer wages, a couple other things. 25, it gets even more intensive. So you do need to list the amount of projects, You need to allude in a sentence or two to the information being sought to discovered, breakdown of qualified cost per project, and you need to report wages by level of involvement. So there's direct, there's support, and then there's supervisory. All those need to be reported. You know, what amount from each total qualified wage amount is per each category. So they'll probably continue to do this, and really all the more reason to file timely, because you never know when these updates are going to come.
So a little bit on Leyton's process and services. As Devin mentioned, typically for timely filers, we'll begin step one, our initial assessment in the fall of this year. This is where we just start to get an understanding of the company, the work that they're doing, and then also let them, ask questions about our process, what we're going to ultimately require from them, and then, come to some type of agreement as far as our timeline. We typically can take, anywhere from 4 to 6 weeks. If the client has, an expedited deadline, we can shorten that. And of course, if they have some, other engagements going on, we can certainly, fit our timeline to theirs. But typically it's about a 4 to 6 week. And that's through the rest of the process here. It's the engagement. It's going to be, the in-person or phone call, emails, and going back and forth to discuss what is being done on the technical side. Because first we have to substantiate the work, and then we can move forward to substantiating the costs and relating those to the R&D activities. So once we have the technical side sorted out, we then start beginning to write that report. We collect various different various costs that are related to these R&D activities and start calculating the credit. We then do our deliverables, which is on the tech side. It's your R&D tax credit report. This is for internal use purposes only. It doesn't get submitted to the IRS, or it doesn't get submitted with any tax filings, but it's there to show you what qualifies, why it qualifies, and the full amount of all your research expenses. We also provide you any of the additional attached statements you might need if you are amending any of your returns. And on the financial side, we provide you all the draft tax forms. So typically, CPAs file within a tax software, so they can just take our forms and copy all the information right on over. But we give you everything that's needed to file and make it an easy process for yourself or your CPA. And we go through a review process where both the client and ourselves will review. The client reviews the work that we provided them, making sure it's all crystal clear, and ask any questions that they might have. And on our side, we review our notes and make sure that any other potential services or products that we have are discussed and potentially passed along to that team, because we're here to help you on the innovation side. But because we have these other processes or these other services here to offer, we want to make sure that we're not just limiting you to innovation if we do think that there's other areas that we can help you with as well. And then once we conduct the study and everything's finalized, we just look to re-engage on that ongoing basis. Typically, it's a lot easier moving forward because we all have a general understanding of the process and what it entails. But on a yearly basis, we just connect, get the same type of information, and then deliver it for the next tax year's credit. And I mentioned a couple different services, that we have here as well. On the left, that's our innovation team. That's, the team that Devin and I are on, working on all things innovation, whether that be research and development, the orphan drug tax credit, or some various grants and incentives. We also have a team that does state and local taxes. This is more, determining if you have a nexus, having to do your voluntary disclosure agreements, reverse sales and use tax audits, or refund reviews. And then on top of that, we have the energy efficiency, which is our cost segregation, which if you guys joined our webinar last week, the One Big Beautiful Bill brought back 100% bonus depreciation. So very, very beneficial if you're doing any type of cost segregation, as well as our array of just commercial or residential real estate products, investment tax credits, things of that nature. So these are all areas that we know what to look for when we're reviewing your financials. We already have your information, so we can certainly just pass it along to that team, see if this is a benefit for you guys, and then do another free consultation and see if it's something we want to work together on in the future. And just about Leyton, most people on this call probably have worked with us or know about us, but we are the worldwide leader in R&D. We've been around for a little bit over 25 years now. First founded in Europe in the 1990s. We're in 17 countries now, I believe it is, working as R&D as our bread and butter. We, of course, have have gotten some other products and services going up in all of our countries, but R&D is the bread and butter in each country. It's what we know, it's what we love. So really, if you guys have any questions on the R&D side, if you have any questions about how this could be beneficial for you or your clients, please feel free to book a meeting, give us a call, shoot us an email. We're happy to hop on another call and see how we can be of help to you guys. Pass it over to some Q&As. I know I've seen some come through.
Yeah, and there will be a recording of this session, and I just typed out that any unaddressed, we'll certainly address the Q&A and kind of publish all that with questions and answers. But we can stay on for 5 to 10 right now. I see several. Ben, feel free to sift through and jump in, but start at the top with a little FIFO method. Grant funding. Companies receiving grant funding, do they qualify for the credit? Yes, in a technical capacity, they definitely still qualify for the credit. What we do with grant funding is basically need to offset the amount of qualified costs being considered to the grant amount. So if you received $100K in NIH funding and you have $300,000 in qualified research costs, we're going to be able to qualify $200,000 of those for the credit. That's rough. It does get more granular than that. If the grant very specifically covered contractors, for example, and most of your qualified costs is wages, then that offset wouldn't be necessary to that extent. But that's roughly the way it goes. We need to back out that grant funding.
Yeah, going next, I just see about internal AI improvements. Certainly they could. It really just depends what the nature of the work is there. Or is the AI being developed internally, or is it just something that is purchased externally and implemented into your own business? When we think of software, you can't just essentially go out, buy something off the shelf and just start utilizing it in your business. You actually have to make some improvements to that software. So internally developed software is what would qualify. So it certainly can, but it would just depend on what work is actually being done and what the end goals are with that product.
Yeah, I saw that one too. I would we have experts on staff, which is useful to know, like technical experts. So we would have a software person kind of conferring with you on this along with us. But I would say if it's off the shelf AI, you can think about like if they're solving all the issues, the process of experimentation and uncertainties and whatnot, not only does that probably not meet the 4-part test, but there's probably almost no costs going into that to comprise a credit. If that's doing all the work, there's really no supplies or wages or contractors partaking, then it would be minimal, if anything, even on top of the probably not qualified on the technical end aspect.
Some hosting costs, R&D. So yeah, those would be included so long as the work that's being done with them is qualified. So certainly they can be qualified. But as far as legal expenses, no, typically legal expenses cannot be included. They're if there are any foreign expenses, they'd have to be amortized, and they used to fall underneath Section 174 and would need to be amortized. But as far as the R&D tax credit, they aren't qualified research expenses, so they can't be included from the R&D tax credit standpoint.
Yeah, I saw another one along those lines. Costs for Slack, Figma, Monday, etc. I don't know what Figma or Monday is, but programs like Slack, we typically know would be the answer. When the IRS puts, they term computer leasing costs. Essentially, this day and age, we're looking at server expense or cloud computing costs. Those that very directly help facilitate the R&D activity versus kind of administrative softwares that help get the work done. My basic understanding, at least, is that Slack could be equated to Teams or Microsoft Word or Office, where it's helping you get the work done, but it's not being directly used to do those software development activities.
Let's see. So as far as the base year R&D credit, when doing the base year, there's 2 different methodologies for calculating the credit. There's the traditional or regular credit, and then there's the alternative simplified credit method. The alternative simplified method uses the past 3 years as a to establish base years. So you take your average research expenses over the past 3 years and compare it to the present year. On the traditional method, it uses what's called a fixed base percentage. So this can go back all the way to inception of when the company was created. And then it essentially starts out at 3% and maxes at a 16%. So it can go back several years, or it could just go back for the prior 3 years. It really just depends what method you're utilizing and really what, if the company was created back in the 1980s, we wouldn't have to go all the way back there. We would essentially say that most likely you'd be maxing out at that 16%, and we'd go with the simplified method. In all cases, we calculate it using both methods because you're able to look at whatever method is most optimal and move forward with that one. So we calculate both methods and then choose the most optimal, the most beneficial to the client.
Yeah, and I don't know if that question was at all misconstrued with the statute of limitations and how many years you can look back to claim, but just to reiterate, that was on one of Ben's slides. You can look back for up to 3 years as well. So we get this little piece of uncertainty out of the way with the new bill and hopefully get clarity on if you didn't do anything in these past few years, can you just amend to claim? That's, I think, the expectation. Then in that case, we could be looking at tax year 2021 or tax year 2022 and onward to claim the credit. It depends on the 3-year statute of limitations, which is you need to amend or return to claim something like this 3 years or earlier compared to when you initially filed it. I got one for trial run for contract customers qualifying as R&D. So that's a little bit of a deeper one, but I'll just say if you're working as a contractor for clients and you're performing trial runs and whatnot, you're likely the one performing the R&D. And so then it's going to come down to analysis as to, do you retain the IP within the work and what is the pay structure within the work? So we want you, considering you as our client, we want you to be paid on a fixed fee sort of basis where you bear the financial risk. If you're performing the work and it fails or it takes way longer than expected, you don't just get paid time and material and get paid a certain amount no matter what you do on a variable basis. The more you work, the more you get paid. We want kind of the opposite, where it's like a capped fee or a fixed fee, and you as the contractor could end up, quote unquote, losing money within the engagement. Then we need to also see that you retain rights to the IP or it's ambiguous at the very least.
Question from Cindy, what about startups in early stages? What is the break-even point of cost of filing for the R&D credit? There typically isn't any additional cost aside from, potentially, the fee for working with us, but it just gets implemented right onto your income tax filing. So your CPA is already doing that work. It shouldn't really be much more for them to do on that nature. And then from the credit standpoint, our fees are typically based off of a percentage of a credit that we're able to identify for you. So in that nature, as long as you're identifying a credit, you're going to come out net positive because we're not charging a fee on anything, more than what you're getting for a credit. So as far as a break-even point, if you're doing R&D, it's definitely worth looking into, and most likely the best option to go forward with claiming that R&D credit. The only time it might vary is if you're a startup but outside that 5-year window, so you can't do the payroll credit and you're not paying any income taxes, that credit isn't being utilized in the current year, so it's going to be carried forward for a couple future years. But still, in that case, you're able to utilize that eventually, and so that break-even point would be once you start paying taxes on the income level if you're not eligible for the payroll tax credit.
Yeah, and I was going to touch on that. The break-even point, it could be assumed you're asking about like when you're going to utilize a tax credit if you're not profitable and paying taxes. That is where the payroll election comes in for startups. Essentially, if you had less than 5 million in sales this year and less than 5 years of prior sales, you can claim that payroll credit where it starts to offset payroll tax paid on a quarterly basis once you file. So that's kind of the workaround. If you're a startup, you're not paying income tax yet, you still have that benefit where you can start immediately saving. And then maybe it's a couple quarters of a break-even point compared to what you're paying us fee wise technically, which we do usually align and make sure you're not paying us too much before you start seeing that benefit.
So a couple questions coming in about domestic versus international R&D. Really, what determines that is where, if it comes down to employees or contractors, where their feet are when the work is being done. So it's not if you're selling the R&D or doing the work for a foreign contractor, it's where the activities are taking place. Is it employees within the U.S.? Is it contractors within the U.S.? Or is it contractors, somewhere international, and therefore those expenses wouldn't be qualified. So if you have a partial outsource to offshore vendors in that sense, the portion that's related to the offshore work wouldn't be able to be included, but anything paid to any employees or contractors working within the United States would be able to be included. So we just call it pretty much, the where are they standing when they're doing the work. And if it's within the the U.S., then we're all good to claim it from the R&D tax credit.
All right. Well, we're being told to wrap it up, Ben. So everyone's still on. Thank you a lot for joining, and we would love to talk to you within the coming weeks or months, whenever you want. So it's an exciting time to have companies start benefiting from this again. Send us an email, a message, go to our website to book a call, and we hope to talk to you all soon. Thank you.
Thanks, everyone. Have a good one.